Hello, everybody, and welcome to our latest podcast. Today, I'm joined by my colleague Stephen Frazer, as usual, and I'm delighted to say we're joined by a special guest, Laura Foll, who co-manages Law Debenture alongside James Henderson. Hi, Laura.
Thanks very much for having me.
No, thank you for joining. Now, Law Debenture's objective is to achieve long-term capital growth in real terms and steadily increase income. And the Trust has got that fabulous record of growing or maintaining the dividend for the last 47 years through this value-driven, diversified portfolio. Steve, did you have a question about the structure of the trust, which is something a bit different?
I think Laura, the first thing to do perhaps is just to kind of lay out Law Debenture, because it's quite unique in the investment trust space, isn't it? So why don't you just give us a quick introduction to how you operate?
Yeah, I will try and give you the 60-second overview of Law Dev, because you're right, it is very unusual. So there's two distinct sides to it that sit within the investment trust itself. So the two distinct sides are: there's a portfolio that's roughly 85% of the NAV, that's a largely UK equities portfolio that's run by me and James Henderson at Janus Henderson.
Yeah.
So that's 85%-ish. Then there's 15%, often more like 20% of the NAV, the net asset value, that is a completely separate independent professional services business. So me and James, just to be really, really clear, are not trying to run a professional services business sort of on the side. This is run completely separately, sort of down the road on Bishopsgate. And it's a collection of things like professional trustees, corporate trust work, a collection of corporate services, so think things like whistleblowing, escrow services, that kind of thing. So that's about 15% of the NAV. And I'm happy to go into it. I know it sounds like an unusual structure, but the structure works, and we can show that it works based on the historic performance and, as you say, the track record of dividend growth, etc. But that's it in a nutshell.
When you have internal conversation about how do you perceive the advantages of this twin model versus any risks?
Yeah, so the key advantage of it is that basically this 15-16% of the NAV gives off roughly a third of the trust overall income.
Right.
So what that allows me and James to do from a portfolio perspective is worry less about delivering a set level of dividend yield. So if you think about us arriving on day one of any, by us I mean me and James, arriving day one of any calendar year, we pretty much know that we've got about a third of the income in the bag.
Yeah.
So what that means from a portfolio perspective is that we can hold zero yielding shares if we want. We can also hold higher yielding shares if we want. It just depends where we see the best total return across the market. And if I look at what's done best for the trust over time, and it will change, this is just the environment at the moment, but what's done best in the last, say, 5 years is often the recovery type stories where, think names like Rolls-Royce, M&S, that kind of thing, where when we've been buying them, they've not paid a yield, a dividend yield, and it would have been hard to hold them in a meaningful way in a more traditional or less unusual structure.
Yeah. So it's greater flexibility, I suppose, at the end of the day, isn't it?
Exactly. So it basically takes what's a fairly narrow investment universe of high dividend yield UK companies and makes that universe bigger. And that's what I guess I want to make clear, is that it doesn't mean that small subset of high yielding UK shares, you can get some great returns from that subset. If you think about some of the banks, things like Tesco, they've done phenomenally well being in that more traditional UK share. So it's not that we ignore that, it's just that the investment universe gets bigger by virtue of this very unusual structure.
Right. And you're one of a rare breed of trusts that's tended to trade at a premium to net asset value, aren't you? To what extent do you think that model is partly to credit for that?
I think in terms of investment trust ratings, there's always a blend of different elements in there. And I don't think it's ever one thing that can say, okay, well, it's definitely down to this. And so what do I mean by that? I mean, I think people look for performance. I think people look for dividend yield and dividend growth. I think people look for transparency. And I definitely think the trust has got better at being transparent over the new CEO's tenure. But I don't think it's any one thing, and I'd be wary of attributing it to just one element. I think people look for all sorts of different things when they're sort of screening within the sector.
Yeah.
Right, yeah. And that dividend record, tell us a bit more about that. So you've got 47 years of maintaining or increasing, and Law Debs is also a next generation hero, aren't you, with 16 years of unbroken growth. How important is that hero status, do you think, to shareholders?
It's very important, and I know the board are very focused on it. It's obviously the dividends, obviously a board decision, but we'd very much be supportive of that and that continued growth track record. I think if I think about the dividend for the trust as a whole, what you see with the professional services business is that it does tend to be what I would class as quite acyclical. So what I mean by that really is, say for the COVID year, where we saw investment income, so from the portfolio, take a really big hit. Now, hopefully we won't have that happen again. That was COVID. It was a very unusual situation. But you saw the IPS business pay almost, I think it was roughly half of the trust dividend that year, because that just carried on when the investment portfolio took a hit. So I think for the trust dividend, the way I see it is it has a bit more of a defensive element to it, because there's the 30% or a third roughly that's not tied to the equity market, that is a bit more resilient, whereas you do obviously, at times like this, when it's slightly more uncertain in the equity market, you might see some dividend cuts here and there, who knows, but that IPS business does have that acyclicality to it.
Yeah, I mean, it's a good segue actually, because I mean we all know there's turmoil in current markets because of obvious geopolitical things that are going on in the world. I just wondered to what extent, I mean, all of those issues are outside of your control. To what extent do you feel as an investment team that you can just put that to one side and just focus on your longer or medium term goals, or do you feel you have to react in some way? And if so, how do you react?
It's a very good question, but we definitely can't ignore what's going on in the wider world. I think in terms of the discussions that we have with company management teams at the moment, to me, it feels almost like deja vu for 2022, when we had a lot of discussions around, how much of your energy cost is hedged, what's your freight cost, and what's your ability to pass that on. And it's a shame to be having those types of discussions again, because it does feel very familiar. I think the types of companies that we are targeting are often market leading businesses that sometimes in quite niche markets. When I say market leading businesses, I think people's mind springs to sort of a Microsoft, and I don't really mean that. I mean, market leading in textile rental in the UK, or sort of van hire, or that kind of thing. But because they're the market leader, they do tend to have a bit more by way of pricing power to pass on those additional costs that are undoubtedly heading their way now. So we can't ignore it. We have to have those discussions with management teams and think about balance sheets and things. But we will not be wholesale changing the portfolio construction, because I think by trying to do that, you risk destroying quite a lot of value, in my view, because we don't know the duration of this. We don't know whether it could be reversed in a month's time. So yes, we go through our investment cases again, and I think try and work out what is now priced in, because some of these more cyclical shares have seen a really substantial derating over the space of a couple of weeks. If you look at some of the retailers in the UK, some of them have almost halved. Some of the house builders would be down over a third within the space of a couple of weeks. So it's just trying to think, okay, what kind of scenario is now priced into these shares? And could it actually end up being not quite as bad as that? Or could, just taking a step back and thinking, okay, what's now in the price? And what we absolutely don't want to be doing is selling some shares that are already pricing in a really severe scenario, because some shares are trading at GFC type multiples now. It's
interesting, isn't it? I mean, history is such an important benchmark. I mean, in this world, we all say history is no pointer to future performance and so on, but it can give us some very educated clues about what's happened in the past and how things have worked out in the past. And what you'll generally find, like the GFC, is ultimately, historical terms, it turns out to look like a pretty small blip, and it felt like the world was under absolute siege and everything was going to change. And of course, 5 years, 6 years on from that, we are in a very different world.
That's the beauty of equity markets, really, over the long term. I mean, these types of companies that we're buying should ultimately have pricing power and the ability to pass on inflation. And clearly, other asset classes, your return is fixed in nominal terms. So if there's going to be something that's more insulated, it should be the equity market. It's just about being careful to be in the companies that can get to the other side of any potential disruption.
And you mentioned retailers. You've got some banks, some oil majors, some engineers even. Are there any sectors that you exclude?
No, we're deliberately very, very open. We have about 150 holdings, which I know looks a long list. And the reason for that is partly coming back to that unusual structure of the trust, is that you could think of it, if you want to think of it this way, is that we've got one position as 16% of the NAV. So from a portfolio perspective, as in the investment portfolio, we are effectively trying to diversify away from that one holding in the professional services business. So there's a reason the list looks very long. And as you say, the list is very diverse. We've got some more domestic cyclical companies in there. We've got some much more resilient businesses like pharmaceuticals, utilities and things. And that is very deliberate, because we didn't see this recent event coming, but these types of unknown things do seem to happen at fairly regular occurrence in recent years. So we need to make sure we've got that diversity in there. So there's no one type of business that we're looking for.
No, I mean, it just occurs to me just to ask, I mean, over the last, say, couple of decades, I think the UK retail investor market's become much more willing to look at companies listed beyond the UK. I just wondered to what extent you have conversations about giving yourself more freedom to invest in perhaps the US, perhaps in Asia or Europe, to give yourself, again, that greater flexibility.
So Law Debenture does have, from a portfolio perspective, about 10% overseas at the moment, and that's split between this, like the US and Europe. And that's pretty low, that 10%, compared to historically. I mean, a very long time ago, there was Law Debenture used to sit in the global sector actually, and then move to the UK. So we do have the flexibility to go overseas. I think where we are at the moment, as I'm sure you've heard a lot of UK fund managers say, there is a valuation discount in the UK market. So we have, if anything, brought money back home. But were that, I mean, I hope it does change, were that to change and the UK to re-rate compared to overseas, we would happily look more overseas. But we would do that the way we go about it, because we don't want to make it unwieldy. That's obviously a very big investment universe, is to say, well, what don't we have an equivalent of in the UK? So the types of things that we've owned historically but don't currently own is things like Microsoft. We've owned things like J&J. We've owned things like Deere, ag equipment. Things that we just don't have an equivalent of here, unfortunately.
Just a final question, really. Is I noticed the gearing. I mean, the trust use gearing to maximise their returns, as they should. You're geared to just over 10% at the moment. I just wonder, given borrowing costs are not as cheap as they have been in recent years, what your viewpoint is on your gearing position.
It's a good question. So the gearing is mostly fixed long-term debt that spans, I think, to the 2030s, and it is at a pretty favourable rate. They have Law Debenture have very recently taken out a revolving credit facility, but most of it is long-term fixed debt. I mean, our sort of take a step back, our longer-term view is use gearing unless we're in a really extreme valuation scenario where we can't see value anywhere. We're definitely not in that scenario, I would say, at the moment. So use the advantage of the investment trust structure to its maximum. So I can't see us, obviously it would be a decision joint with the board, but I can't see us changing that on a shorter term view, because we think there is a lot of value out there, and this is a portfolio that would be on a low teens PE, which, yes, there can be events that we can't foresee, but if you just take that step back, that valuation looks pretty attractive to us.
No, that's really, really interesting. Thanks very much for your time. Much appreciated. That's Laura Foll, co-manager of the Law Debenture corporation. It's not actually called an investment trust. It's worth noting that, but it is an investment trust. Thank you very much for your time. Look forward to hearing from you again. See you next time.
Thanks very much.